Picture this. It's Tuesday morning, October 22, 1907, Fifth Avenue, New York City. Before the sun's even fully up, there's already a mob forming outside the marble columns of the Knickerbocker Trust Company. Not a protest, a stampede. Thousands of people, shoulder to shoulder, screaming, shoving, some literally fighting their way to the doors, all demanding the same thing, their money, right now. By noon, $8 million gone, vanished. The bank closes its doors forever, and the man who ran it, Charles Barney, he'll be dead in 3 weeks. Suicide. A single bullet to the head in his mansion bedroom. But here's what they don't teach you in school. This wasn't just a bank run. This was the moment one man, just one private citizen, became more powerful than the entire United States government. For 10 days, J.P. Morgan didn't just save the American economy from total annihilation, he owned it. He decided which banks lived and which ones died. He locked Wall Street's most powerful men in his private library and refused to let them leave until they signed over millions. He forced the President of the United States to give him a monopoly that would have landed anyone else in prison. And when it was over, when the smoke cleared and millions were ruined, Morgan walked away with something far more valuable than money: control. Total, absolute control over America's financial future. Stick around, because by the end, you'll understand why your great-grandparents never trusted banks and why the system we have today, the Federal Reserve, the entire architecture of American finance, it all traces back to 10 days in 1907 when one man proved he was more powerful than democracy itself.
Let's rewind. October 1907. America's economy is running hot. Too hot. Stock market's been on a tear for years. Trust companies, these are like banks on steroids, less regulated, more risk, more profit. They've exploded. Their assets have grown 244% in just 10 years. Regular banks, only 97%. Why? Because trusts play by different rules. National banks have to keep 25% of deposits in reserve. Trusts try 5%. They're lending money to stockbrokers with basically no collateral, making massive bets on railroad stocks, copper mines, real estate schemes. It's a house of cards built on leverage and optimism, and everyone's getting rich. Until they're not. Enter Otto Heinz, copper speculator, wildly ambitious, catastrophically stupid. Otto's got a plan. He's noticed that shares of United Copper Company are being shorted heavily. Lots of brokers borrowing shares, betting the price will drop. Otto thinks, what if I buy up all the shares, corner the market, and then force these short sellers to buy from me at whatever price I demand? It's the financial equivalent of a hostage situation. The problem? Otto doesn't have nearly enough money, so he goes to his brother Augustus Heinz, who runs Mercantile National Bank, and their buddy Charles Morse, who controls the National Bank of North America and a steamship monopoly, and they know another guy, Charles Barney, president of the third largest trust in New York, the Knickerbocker, married into the Whitney family, old money, respect, power. They need Barney's money to make this work. Barney, to his credit, says no, too risky. But Otto, drunk on greed and delusion, decides to try anyway.
October 14th, 1907. Otto starts buying United Copper stock like a maniac. Price jumps from $39 to $52 in one day. He's pumped. Next day, Tuesday, October 15th, the stock shoots even higher, nearly $60. Otto issues the call. Short sellers, time's up. Deliver the stock or pay me. Except, plot twist, the short sellers find shares everywhere. Otto didn't control anything. He misread the entire market. The price doesn't just fall, it collapses. Closes at $30 on Tuesday. Wednesday, October 16th, it opens at $36 and crashes to $10 by close. Otto's brokerage firm, Gross & Kleberg, it implodes, can't pay, shuts down. Heinz's personal fortune? Gone. But the real carnage is just beginning. By October 17th, word's out. Heinz's bank, Mercantile National, it's connected to this disaster. Depositors panic. Lines form. By October 19th, Morse is forced out of his banks. But the big domino? That's Knickerbocker's. Even though Barney refused to fund Otto's scheme, people think he's involved. Rumors spread. Guilt by association. On October 18th, Friday, whispers start. Barney knows Morse. Barney's seen with these guys. What else is Knickerbocker hiding? Over the weekend, the pressure builds. Depositors start pulling money quietly. By Monday, October 21, the board of Knickerbocker has one option. They force Barney to resign, publicly, humiliatingly. That afternoon, the National Bank of Commerce, where J.P. Morgan is a major power, announces that will no longer clear checks for Knickerbocker. That's the kiss of death. It's a signal to the market. This bank is finished. The next morning, October 22, the doors open and hell breaks loose. People are lined up around the block. Some have been waiting since before dawn. Inside, tellers are counting out cash as fast as humanly possible. But trust companies only keep 5% in reserve, remember? There's not enough. There will never be enough. By noon, $8 million withdrawn. Knickerbocker closes. The panic doesn't stop. It spreads, like a virus. Trust Company of America, the second largest trust in New York, it's next. $13 million gone in one day. Then Lincoln Trust, then a dozen smaller banks. By Thursday, October 24th, banks are failing in Brooklyn, Providence, Pittsburgh. The entire system is seizing up.
And here's where it gets terrifying. The United States government has no mechanism to stop this. No central bank, no Federal Reserve. The Treasury tries. Secretary George Cortelyou deposits $35 million in federal money into New York banks. It's not enough. The money supply is tied to gold reserves and government bonds. It's rigid, inflexible. Printing more requires an act of Congress, and Congress isn't in session. The economy is a patient coating on the table, and there's no defibrillator. So, who do they call? J.P. Morgan, 70 years old, semi-retired, spending most of his time in his brand new private library on Madison Avenue, surrounded by rare manuscripts and Renaissance art. He's already bailed out the U.S. Treasury once during the Panic of 1893, personally lending the government gold to keep the dollar afloat. He's the most powerful banker in America, probably the world. He controls U.S. Steel, half the country's railroads, General Electric. He's got partners on the boards of 112 corporations worth a combined $22.5 billion in today's money. When Morgan talks, Wall Street listens. When Morgan moves, markets move. Saturday night, October 19, Morgan's at a church convention in Richmond, Virginia. News of the crisis reaches him. He cuts his trip short, takes the overnight train back to New York, arrives Sunday morning. By Monday, his library becomes the war room. A revolving door of bankers, trust presidents, government officials, all coming to Morgan, explaining the situation, begging for help.
Morgan doesn't just listen, he interrogates. He brings in Benjamin Strong, a vice president at Bankers Trust, brilliant analyst, later the first head of the New York Federal Reserve. Strong and his team audit the failing institutions. Knickerbocker, Morgan examines the books, decides it's insolvent, lets it die. Cold calculation. But Trust Company of America? That one's connected to Morgan's clients, his partners, his network. Strong audited overnight, Tuesday into Wednesday. By Wednesday afternoon, Morgan makes his call. This is the place to stop the trouble. He commits $3 million of his own money to keep Trust Company of America afloat. He calls George Baker, president of First National Bank, and James Stillman, president of National City Bank, the ancestor of Citibank. Together, they create a liquidity pool. They're funneling money from strong banks to weak ones, liquidating assets, moving capital like chess pieces. Wednesday, they keep Trust Company of America open through close of business, barely. But Morgan knows Thursday is going to be worse. He needs more money, lots more. Thursday morning, October 24th, the stock market itself is on the brink. Interest rates on call loans, overnight loans to brokers using stock as collateral, they're spiking. Normally 9.5%. By the time Knickerbocker closes, 70%. 2 days later, 100%. Some brokers can't get credit at any price. Without credit, brokers can't buy stock. Without buyers, prices collapse. The New York Stock Exchange is minutes from shutting down entirely, and if that happens, it's over. Full economic meltdown. The president of the stock exchange literally runs to Morgan's office. We need cash now, or we close. Morgan doesn't hesitate. He summons every major banker in the city to his office. Not a request, a command. Within minutes, he's raised $27 million. He delivers it directly to the loan post at the stock exchange. Brokers can now borrow, markets stabilize, the exchange stays open. Crisis averted, for now. But the real power move? That happens Sunday night, November 3, 2 weeks into the crisis. The trust companies are still hemorrhaging deposits. Morgan's been working around the clock, barely sleeping. His library has become the nerve center of American capitalism. On Sunday afternoon, Morgan summons the presidents of all the major trust companies to his library. They arrive one by one. Ushered into the West Room, Morgan's private study, Red silk walls with the insignia of the Cheeky family, a Siennes banking dynasty. Fireplace big enough to stand in, shelves lined with rare books, a secret vault hidden behind a sliding bookshelf where Morgan keeps his most prized manuscripts. And once everyone's inside, Morgan does something audacious. He locks the doors. Not metaphorically, literally. The front doors of the library are locked from the outside. No one's leaving. Morgan's message is clear. You're not going home until we fix this. The trust presidents talk, they negotiate, they argue. Hours pass, midnight, 1 a.m., 2 a.m., nothing. These men are terrified of committing their own money to save their competitors. What if they go under too? But Morgan isn't asking. He's deciding. Around 4 in the morning, Morgan's had enough. He's sitting in his study, playing solitaire. Yes, solitaire. It's how he thinks, calm, methodical, unbothered by the chaos around him. He summons his partners. They draft a document, a pledge. Every trust president commits a certain amount to a bailout pool, $25 million total. Morgan's staff hand out the papers. Sign here. No negotiating, no leaving until it's done. One by one, exhausted, beaten down, they sign. By dawn, it's over. Morgan unlocks the doors. The trust presidents stumble out into the cold November morning. They've just been held hostage by the most powerful private citizen in America, and they've agreed to his terms.
The bailout works. By mid-November, the panic's over. But the cost? Staggering. The Dow has lost 48% of its value since January 1906. 16 banks and trust companies have failed. Thousands of businesses have gone bankrupt. Unemployment's spiked. Ordinary people, factory workers, farmers, they've lost their savings. Some of Knickerbocker's prominent depositors, people who trusted Barney, they commit suicide when they realize their money's gone forever. And Charles Barney himself? November 14, 1907, 3 weeks after being forced out. He's in his bedroom on East 38th Street. Still wealthy, by the way, still has about $2.5 million in assets, but disgraced, humiliated, blamed for a disaster he tried to avoid. He picks up a gun and shoots himself. Dead at 56. The man's life destroyed by proximity to a copper scheme he refused to touch. But Morgan's a hero. Wall Street throws him a parade of praise. Treasury Secretary Cortelyou calls him a patriot. President Theodore Roosevelt, the trust buster himself, the guy who spent years trying to break up monopolies, he's forced to admit Morgan saved the economy. But here's the kicker. Morgan didn't just save the system. He used the crisis to expand his empire. During the panic, a brokerage firm called Moore & Schley is about to collapse. They're heavily invested in Tennessee Coal, Iron, and Railroad Company, TCI. If Moore & Schley fails, TCI stock crashes, and the panic gets worse. Morgan sees an opportunity. He arranges for U.S. Steel, which he controls, to buy TCI for $30 million. There's just one problem. U.S. Steel already controls 60% of America's steel market. Buying TCI would create an even bigger monopoly, and that's illegal under the Sherman Antitrust Act. So what does Morgan do? He sends U.S. Steel President Elbert Gary and partner Henry Frick on an overnight train to Washington.
They meet with Roosevelt at the White House on Sunday morning, less than an hour before the stock exchange opens. Roosevelt's personal secretary tries to turn them away. No meetings. Frick and Gary convince the Secretary of the Interior to bypass the secretary, get them in front of Roosevelt. They explain the situation. TCI fails, market crashes, panic spreads. Roosevelt's boxed in. The economy's hanging by a thread. He agrees, grants them immunity from antitrust prosecution. U.S. Steel buys TCI for $30 million. Morgan just turned a crisis into a massive corporate expansion. And he did it with the president's blessing. If you're sitting there thinking, wait, one man had this much power? One private citizen could decide the fate of banks, the stock market, entire industries, and the president just went along with it? Then you're starting to get why people were furious. And if you're realizing this story isn't just history, it's a blueprint for every financial crisis since, from 2008 to today, then you're seeing what I'm seeing. Before we get to how Morgan's 10 days built the system that still controls your money, do me a favor. If this is blowing your mind, if you're angry, curious, whatever, hit that subscribe button right now, seriously, and smash the bell icon so you don't miss the next one where we unpack how this exact playbook was used in 2008 and why nothing's really changed. Also, drop a comment below. Tell me where you're watching from and what time it is for you right now. I love seeing how far these stories reach. New York, London, Mumbai, let me know. Your support keeps this channel alive. All right, back to 1907, because we're not done yet. So, the panic's over. Markets stabilize. Banks reopen. But the questions start immediately.
How did one man have so much power? What if Morgan had said no? What if he'd been out of the country, or dead? Or just didn't feel like helping? Was America's entire economy really dependent on the goodwill of a 70-year-old banker? Congress wants answers. In 1912, they launched the Pujo Committee hearings, named after Louisiana Representative Arsène Pujo. The goal? Investigate whether Wall Street is controlled by a money trust, a cartel of bankers colluding to manipulate markets and crush competition. Morgan's the star witness. December 18 and 1912. He's 75 now, frail, his health's declining, but he walks into that hearing room like he owns the place, because in a sense, he does. The committee grills him. They lay out the facts. Morgan and his partners sit on the boards of 112 corporations. Those corporations are worth $22.5 billion combined. They control banks, railroads, steel, electricity, telegraphs, insurance companies. They decide who gets loans, who gets credit, which businesses expand, which ones fail. The committee asks, isn't that a monopoly? Isn't that a money trust? Morgan's answer is legendary. He says, no. It's not about money. It's about character. People trust me because of my reputation. Credit is a matter of character. The committee's stunned. This man, who just orchestrated the biggest private bailout in American history, who locked bankers in a room and forced them to sign his deal, who got the president to grant him a monopoly, he's saying it's all about trust. Personal trust. Not laws, not regulations, not government oversight. Just trust in J.P. Morgan. And here's the wild part. He's not entirely wrong. In 1907, there was no Federal Reserve, no deposit insurance, no SEC, no regulations requiring banks to disclose their balance sheets. The system ran on reputation and relationships. If Morgan said a bank was sound, people believed him. If he said it was toast, it was toast. But that's exactly the problem.
The Pujo Committee digs deeper. They find that Morgan and his partners have interlocking directorates across every major industry. If you want to start a railroad, you need Morgan's approval. If you want to issue bonds, you go through Morgan. If you need capital for a factory, a mine, a utility, Morgan decides. It's not a free market. It's a controlled market, and Morgan's at the center. The committee's final report, released in 1913, says it outright. There is a money trust. A small group of men in New York control the flow of capital in America. They don't compete. They coordinate. They pick winners and losers. And the Panic of 1907 proved just how much power they wield. The public's livid. Newspapers run cartoons of Morgan as a king, a dictator, a giant octopus with tentacles wrapped around the Capitol building. Populists, progressives, farmers, workers, they all want the same thing. Break up the money trust. Regulate the banks. Create a public institution that can respond to panics without relying on one man's whim. And they get it. Sort of. In November 1910, just 3 years after the panic, a secret meeting happens. Senator Nelson Aldrich, chairman of the National Monetary Commission, invites 6 men to Jekyll Island in Georgia, a private club, millionaires only. J.P. Morgan's a member. November 22, 1910, they leave from Hoboken, New Jersey in Aldrich's private railroad car. Under assumed names. They tell people they're going duck hunting. One guy even brings a shotgun as a prop. They arrive at Jekyll Island, enjoy Thanksgiving dinner on November 24th, wild turkey with oyster stuffing. But they're not hunting ducks. They're writing the blueprint for a central bank. They lock themselves in the Jekyll Island clubhouse for 9 days. No press,
no public, total secrecy. The attendees? Aldrich himself, his private secretary Arthur Shelton, Henry Davidson from J.P. Morgan and Company, Paul Warburg from Kuhn Loeb, Frank Vanderlip, president of Rockefeller's National City Bank, and A. Pyatt Andrew, assistant treasury secretary. 6 men representing the biggest banking interests in America. They don't want anyone to know Wall Street bankers are designing the new financial system, because if people knew, the plan would be dead on arrival. What they create is the Aldrich Plan, a central bank, but not one central bank, a network of regional reserve banks coordinated by a central board. It would control the money supply, set interest rates, lend to banks in a crisis. Basically, it would do what Morgan did in 1907, but as a public institution. Except, here's the twist. The bankers at Jekyll Island make sure they still have influence. The regional banks would be owned by private member banks. The board would include bankers. It's a hybrid, part public, part private, controlled by the government, but run by Wall Street. The Aldrich Plan gets introduced to Congress. It dies immediately. People see Nelson Aldrich's name, Rockefeller's father-in-law, and they assume it's a banker power grab, which it kind of is. But the idea doesn't die. In 1913, Democrats take control of Congress and the White House. President Woodrow Wilson's committed to banking reform. Virginia Representative Carter Glass and Senator Robert Owen introduce a new bill, the Federal Reserve Act. It's almost identical to the Aldrich Plan. Same structure, same regional banks, same tools. The only real difference, the Federal Reserve Board is appointed by the president, not controlled by bankers, at least on paper. On December 22, 1913, Congress passes the Federal Reserve Act. Wilson signs it the next day, December 23, 1913. The Federal Reserve System is born. And the man who made it necessary, J.P. Morgan, he's dead. He died 9 months earlier, March 31, 1913, in Rome. His health collapsed after the Pujo hearings. Associates said the stress, the scrutiny, the public anger, it broke him. He was 75.
He left behind one of the largest private art collections in history, now housed in the Morgan Library, and a banking empire that would become J.P. Morgan Chase, one of the biggest banks in the world. But his real legacy? The Federal Reserve, the system created to make sure America would never again depend on one man to save the economy. Except, did it work? Fast forward to 1929, the stock market crashes. The Federal Reserve, instead of flooding the system with liquidity like Morgan did, tightens. They reduce the money supply. Banks fail by the thousands. The Great Depression hits. Unemployment reaches 25%. It takes a decade and a world war to recover. Or jump to 2008, the financial crisis. Lehman Brothers collapses just like Knickerbocker in 1907. Banks freeze, credit markets seize up, and who steps in? The Fed. They flood the system with liquidity, just like Morgan. But they also use taxpayer money to bail out the biggest banks. Too big to fail, they call it. Sound familiar? One man deciding which banks live and die? Try one institution, the Fed, with the Treasury Secretary doing the exact same thing Morgan did, picking winners and losers, forcing mergers, guaranteeing debts. The names change, the tools get more sophisticated, but the structure, it's the same. Here's the uncomfortable truth. The panic of 1907 didn't just lead to the Federal Reserve. It revealed something fundamental about capitalism. When a crisis hits, when the whole system's on the brink, you need someone with the power to act fast, to move money, to make hard calls. In 1907, that was J.P. Morgan. Today, it's the Fed. But either way, it's concentrated power. Whether it's in the hands of one man or one institution, the ordinary person, the depositor, the worker, they're at the mercy of decisions made behind closed doors. Morgan locked bankers in his library until they signed his deal. The Fed locked bank CEOs in a room in 2008 until they accepted bailout money, even the ones who didn't want it.
Different century, same playbook. And the people who pay? It's never the Morgans of the world. It's the Charles Barneys, the factory workers who lost their jobs in 1907, the homeowners who lost everything in 2008. The system protects itself. It always has. That's what Morgan proved. He didn't save the economy out of altruism. He saved it because his empire depended on it. And when he was done, he owned even more. U.S. Steel got TCI. Morgan's banks absorbed the failed ones. The crisis made him richer and more powerful. And the Federal Reserve? It's not some neutral arbiter. It's run by people from Wall Street, advised by bankers, responsive to the financial system's needs. When it was created, Benjamin Strong, Morgan's right-hand man in 1907, became the first head of the New York Federal Reserve Bank. The guy who audited the failing banks during the panic, who helped Morgan decide who lived and died, he's now running the institution designed to replace Morgan. You see the problem? The system didn't change. It just got a new name.
So here's what you need to take away. The Panic of 1907 wasn't just a financial crisis. It was a transfer of power. For 10 days, J.P. Morgan became America's shadow government. He controlled more than the president, more than Congress, more than any elected official. And when it was over, when people demanded reform, the solution wasn't to break up the banks or distribute power. It was to institutionalize Morgan's role, to create a Federal Reserve that could do what he did whenever it needed to, forever. That's the legacy. Not that Morgan saved the economy, but that he proved one man could. And in proving it, he built the system we still live under today. Every time the Fed cuts rates, raises rates, injects liquidity, bails out banks, that's Morgan's ghost, playing solitaire in his library, deciding who survives and who doesn't. So the next time you hear about a financial crisis, about too big to fail, about emergency bailouts and closed-door meetings, remember 1907. Remember the Knickerbocker. Remember Charles Barney, dead in his bedroom. Remember the thousands of people who lost everything while Morgan walked away richer. And ask yourself, has anything really changed? Or did we just trade one man's library for a marble building in Washington, still making the same decisions, still protecting the same people, still leaving the rest of us to deal with the fallout? That's the story they don't tell you, but it's the one you need to know, because history doesn't repeat, but it sure as hell rhymes. Thanks for watching. Stay curious, stay skeptical, and for God's sakes, don't trust the people who tell you to just trust them. Power respects power. The rest of us, we're just hoping the doors don't lock when we're inside.